Welcome, everyone. Have you ever really stopped to think about what separates a truly successful, thriving business from one that just, well, gets by? It's not always about having some brilliant, once-in-a-generation product. More often than not, it comes down to making consistently smarter decisions. Today, we're going to pull back the curtain on managerial accounting. This is the secret language, the playbook, that allows managers to see around corners and actually shape the future of their business. I'm Professor Strategist, and with me is my colleague, Professor Quant. Together, we're going to hand you that playbook.
So, here's our roadmap for today's lecture. First, we'll reframe accounting as the true language of business. Then, we'll get into the nitty-gritty of costs, fixed versus variable. From there, we'll build up to a really powerful tool called CVP analysis. Then, we'll get into the fun stuff, forecasting and playing out what-if scenarios. We'll also spend some crucial time on the ethical dilemmas you'll face. And finally, we'll wrap it all up and give you a complete decision-making toolkit. By the time we're done, you'll see exactly how all these pieces fit together.
Okay, let's dive right in. The first thing we have to do is challenge a very common and, frankly, very wrong idea about what accounting is. When I say the word accounting, what's the first thing that pops into your head? For a lot of people, it's, a bookkeeper in a back room with a green visor, just tallying up old receipts.
Right. The perception is that it's all about looking backward, just recording history. And to be fair, there is a branch of accounting, financial accounting, that is very much concerned with accurately reporting past performance to people outside the company, like investors and banks. But think about it. Is the purpose of a business simply to document its own history, or is it to create its future?
Exactly. Managerial accounting, which is our focus, is all about looking forward. It takes all that historical data and transforms it into a guide for what to do next. Here's the best analogy I can give you. Financial accounting is like the rearview mirror in your car. It's absolutely essential for seeing where you've been. But managerial accounting, that's your windshield, your dashboard, and your GPS, all rolled into one. It helps you see the road ahead and make the right turns to get where you want to go.
So to navigate that road, you have to understand the vehicle you're driving. You need to understand its engine, its DNA. And the fundamental DNA of any business is its cost structure. For our purposes today, this DNA is composed of two primary strands that behave in completely different ways.
And getting this distinction right is absolutely fundamental. Everything else we do today builds on this. Fixed costs are the expenses you're on the hook for no matter what. Think of your rent or insurance. You pay that bill whether you sell one item or 1,000,000 items. They are fixed in total. Variable costs, on the other hand, are tied directly to your level of activity. If you run a t-shirt business, the cost of the blank shirts is a variable cost. The more shirts you sell, the more you spend on blank shirts. It's a one-to-one relationship.
Now let's make this tangible with our case study for today, The Grind, a student-run coffee cart. Look at their costs. The campus permit and the barista's salary are fixed. Add them up, that's $2,000 a month they have to pay just to open the doors, even if they don't sell a single cup. But the coffee beans, the milk, the paper cups, those are variable. They only incur those costs when they actually make and sell a coffee. Understanding this behavior, this DNA, is the absolute bedrock for every strategic decision that follows.
All right, now we can take that foundational knowledge of costs and use it to power up what I like to call the CVP analysis engine. CVP stands for cost, volume, profit. And this engine is going to help us answer the single most critical question for any business. At what point do we stop losing money and actually start making it? In other words, where is our break-even point?
Okay, but before we can calculate that break-even point, we need to introduce a concept that is, well, it's the key that turns the entire engine. It's called the contribution margin. Think about it this way. For every cup of coffee you sell, some of that money has to immediately pay for the variable costs, the beans, the milk, the cup. What's left over? That is the contribution margin. It's called that for a reason. It's the amount that each individual sale contributes toward paying off that big mountain of fixed costs. Once that mountain is paid off, every dollar of contribution margin from every sale after that is pure profit.
Let's run the numbers for The Grind. We start with their selling price, which is $4 per coffee. And from that $4, we immediately subtract the variable costs for that one cup. That's $1 for the coffee and milk, plus 50 cents for the cup and lid, so a total of $1.50.
The math is simple. $4 minus $1.50 leaves us with a contribution margin of $2.50. So every single time the barista sells a coffee, $2.50 is generated to help pay down those fixed costs.
And what were those fixed costs again? That's right, the permit and the salary. That's our $2,000 mountain that we have to climb over every single month.
So now the question is simple. How many $2.50 contributions does it take to conquer that $2,000 mountain? The logic is just a simple division problem. We take our total fixed costs and divide by the contribution margin we get from each unit. $2,000 divided by $2.50 per coffee gives us 800 coffees. That is the magic number. The grind has to sell exactly 800 coffees a month just to cover its costs. The 801st coffee? That's when they start making a profit.
Now, knowing your break-even point is 800 coffees is great, but that's just the beginning. That number isn't some static fact you just put in a report. It's a dynamic tool you can use for strategic planning. This is where managerial accounting really comes alive. It lets us play out these what-if scenarios to see the potential impact of our decisions before we actually commit to them.
Let's put ourselves in the manager's shoes at the grind. They have an idea. They're thinking, what if we lower our price to $3.50? Maybe we can attract more customers and boost our sales from 1,000 units a month to, say, 1,500. On the surface, more customers, more sales, that sounds good, right? But in business, gut feelings can be incredibly expensive. We have to run the numbers. Professor Quant, walk us through the analysis. Should they take this risk?
Let's break it down. Under their original plan, selling 1,000 coffees at $4, they're clearing their 800-unit break-even point and making a $500 profit. Not bad. Now, let's analyze the new plan. Dropping the price to $3.50 shrinks their contribution margin from $2.50 down to just $2 per cup. This, in turn, pushes their break-even point higher, from 800 units up to 1,000 units. So the risk is greater. They have to sell 200 more coffees just to get back to zero profit. However, if, and this is a big if their forecast is accurate and they really do sell 1,500 units, their total profit doubles from $500 to $1,000. The data doesn't give them the answer, but it illuminates the trade-off, allowing them to make an informed, strategic choice.
And that brings us to, frankly, one of the most important parts of this entire discussion. Having the data is only half the battle. How you use that data, how you talk about it, and the decisions you make based on it, that carries an immense professional and ethical weight. Remember, the numbers themselves don't make decisions. People do. And you are responsible for speaking for those numbers with absolute integrity.
I want you to really let this sink in. Ethics are not some soft skill or an optional add-on in accounting. They are the bedrock. They are the foundation upon which our entire system of commerce is built. The only reason investors are willing to put capital into a company is because they trust the financial information. Without that bedrock of ethical behavior, that trust completely evaporates. To ensure that trust is maintained, professional bodies have established these core ethical pillars: confidentiality, integrity, objectivity, professionalism. Now, a very common mistake students make is to see these as just vague guidelines. They are not. They are hard and fast professional obligations. Integrity means you are honest and candid even when the news is bad. Objectivity means you present the data without bias, regardless of how it might affect you personally. Violating these isn't just a mistake, it's a professional failure that can end a career.
So let's bring this back to the grind. Imagine a supplier comes to the manager and says, hey, I'll give you a huge 20% discount if you switch to these non-organic beans. And hey, don't worry about changing that 100% organic sign on your menu. Now, what would the numbers say? This CVP analysis would look amazing. Variable costs would plummet, contribution margin would soar, the break-even point would drop, the spreadsheet would be screaming, do it. But this is a blatant violation of integrity. This is the moment a manager's role shifts from being a number cruncher to an ethical leader. The decision is no longer about profit. It's about character and long-term trust.
Okay, we have covered a tremendous amount of ground today. We've gone from the basic DNA of costs all the way to complex ethical leadership. So let's pull all these threads together and consolidate everything into a practical toolkit that you can take with you and apply.
Let's recap what's in your toolkit now. First, you have cost analysis, the ability to look at any business and separate its fixed and variable costs. Second, contribution margin calculation. You can determine the true per-unit profitability of any product. Third, break-even analysis. You can find that critical point where a business becomes profitable. Fourth, what-if scenario forecasting. You can model the future. And fifth, underpinning it all, you have an ethical decision-making framework. This isn't just a list of concepts. These are 5 powerful tools to lead a business effectively.
So we'll leave you with this one final thought to ponder. You now possess this toolkit. You've begun to learn the language of business.
The next time you walk into any business, a coffee shop, a retail store, anything, what is the first strategic question you would ask now that you know how to look beneath the surface? The numbers tell a profound story, and you now have the power not just to read that story, but to help write its next chapter.